Good afternoon. Today is Tuesday afternoon, September 1st, 2020. I'm Joe Terril, president of Terril & Company, independent wealth managers in St. Louis, Missouri. Since the COVID came upon us, and the markets have become as volatile as they are, we've been posting these, what we're calling extraordinary updates. And we're back today to discuss our outlook and thoughts. First, we are bullish on a continued economic recovery. The incidence of COVID in the United States is dropping. The severity of COVID in the United States is dropping. If we go back to the third week of July, we saw up to 75,000 new cases per day. The figures out yesterday were 27,000 cases. Many of the cases are with young college students that are returning to school, and they are in the least risk category. So we see certainly hospitalizations dropping. We see number of people in intensive care dropping, and thankfully we also see deaths dropping in the United States due to the COVID. So as this continues, we believe the world economy will continue to open up more and more, and we will have a sharper recovery than what many others expect. Everywhere in the world that they are open, the economy is doing better than what people predicted. We think that will be the case here in the United States, and we think it'll be the case around the world. There is worries about Europe, and maybe Europe is having a second wave. These things are going to happen, but in general, we think that we are well on our way to getting to the other side of this terrible COVID. In addition to it, we are very confident that we'll get a vaccine for COVID. There are a number of companies working on this around the world, and what I can read from their scientists at these companies, they say there is nothing about this virus that surprises them. They're not seeing anything that is incredibly unusual from other viruses they've dealt with. And I think that's the reason why we're getting such good results in phase 1 and phase 2 testing. There are a number of people now in phase 3 and, if you will, final testing. And we believe we will have a vaccine for the virus in the next couple of months. And certainly that's going to encourage the economy to open up and, if you will, surge. Around the world, economic figures out of China in the last few days, and in particular today, are all the way back to where they were pre-COVID. And we believe we are going to see this in the balance of the world as we get post-COVID. With that said, as it relates to investments, there's really two investment markets out there, and I don't mean bonds and stocks. I mean high-tech glamour growth stocks and then everybody else. High-tech glamour growth stocks is a bubble. It will end terribly for people. We urge you, please be careful running out and paying whatever price is being asked for these companies, with the idea that, well, they're going up and they'll keep going up for some unknown reason, and there'll never be any problems and they'll go up, and or I will be smart enough to sell them before they come back down. I want to give a couple of examples of what I'm talking about. Let's start with the one everybody loves, Apple. Apple has over a $2 trillion market capitalization. This is more by itself than the entire Russell 2000 index, all 2,000 companies put together. Here are your results in the last 5 completed financial years for Apple, plus this year of 2020 as an estimate. So for 6 years, Apple has averaged on an annual basis, 2% sales growth. Cash flow is lower today than it was in 2015. Earnings are flat with what they've been for the last 6 years. Gross profit margins are down by almost 1/3, and debt is now up to $122 billion. I don't see this as a company that deserves to be up 4 or 5-fold, and I certainly don't think simply because they said they were going to offer a stock split that the company should be up 33% just because they split the stock. As everybody knows, a stock split doesn't create any wealth. It creates more speculation. I want to go on to Netflix. Netflix is a company that 10 years ago had $200 million in debt. Here we are today, and by the end of this year, they'll have $22 billion in debt. They didn't make a major acquisition. They didn't pay out big cash dividends. They're not buying back the stock. If not for Hollywood accounting, which means you get to defer your expenses, but yet book your revenue now, why is this company in need every year of borrowing $3 to $4 billion to continue operations? The biggest, excuse me, my personal opinion here coming through one, is Tesla. And May 1st of this year, the man running the company, Elon Musk, said the stock was overvalued. It's up almost 3 to 4-fold since then. Tesla will sell about 400,000 cars this year. The market at this price believes Tesla is worth more money than Toyota, Honda, General Motors, Ford, Daimler, Benz, all put together don't equal the market capitalization. Between those companies, they sell almost 25 million cars a year versus Tesla's 400,000. Tesla is also a business that is dependent upon the government for subsidies. If not for the federal government, the state of California, giving them tax credits, Tesla would show no cash flow of any kind. Last quarter, they pre-sold these tax credits in order to generate the cash to make the earnings number that they reported. Ridiculously priced. They're going to sell $5 billion worth of stock to raise more money. This has been the MO with the company for quite some time, which is sell stock, raise more money, figure out later how you're going to make this a valid, sustained business. There's plenty of competition coming in electric vehicles. And I want to go on to the one that was created today, and that is Zoom Technology. Zoom Technologies is a great product, but they're not the only person making this. There is tremendous competition out there and coming. They've been a beneficiary of the stay-at-home business work environment, and this isn't going to be with us forever as we get to the other side of the COVID. But Zoom today is up 130 points to $455 a share, and the market value of Zoom is putting it in a position that it's worth more money than IBM. Zoom is worth more money than Caterpillar and Starbucks put together. Which company would you rather have? Starbucks and Caterpillar Tractor, or would you rather have Zoom? It's not to say it's not a good product. I've been using it and others. But this just gives you an idea of some of the speculation that is going on in some of these glamour tech stocks. When you switch to everybody else, particularly companies that we like that are very tied to the economy, they're selling at modest multiples. They're still down 30 to 40% from where they were pre-COVID. And these companies are made up of banks, paper companies, chemical companies. The pharmaceuticals are ridiculously priced in relationship to what they have to offer. They're not even selling at a market multiple. and generating tons of cash, paying dividends. So we are concentrated in the stocks most tied to the economy. We think between now and the end of the year, those are the stocks that will participate and where we'll make the best rate of returns. Certainly, we are confident that this glamour tech stock market of buy it, it's going higher, buy it, it's going higher, don't worry if they make any money, don't worry if they generate cash, just buy it because it's going higher. That's a game of musical chairs. And when the music stops, people are going to get hurt, and hurt in a big way. We want to mention one more thing, and that is the potential for higher rates of inflation. We believe this is coming. It's getting a lot of conversation right now from people that you're injecting $5-6 trillion worth of printed money into the United States economy. Other central bankers around the world are doing the same with their economies. There's no such thing as free money. You put that much money into the economy, it debases the value of the existing currency. We believe that we will see inflation pick up to 3 to 4% in the next 12 months. We're already seeing the early signs of it. I want to point out that almost a $2,000 gold market close to record highs is somewhat of a signal. Seeing prices of other commodities and what they're doing is also telling us that we will see higher rates of inflation. With higher rates of inflation also will come a meeting of the minds at the Federal Reserve Bank to say, how are you going to hold interest rates at 0 on short-term rates, at 0.75% on a 10-year government bond if inflation begins to run at 3 to 4%. I know what was said this week by the Federal Reserve governors about we're going to average inflation and all the different things we're going to do, but we believe you'll see higher rates of inflation, and it's going to force the Fed's hand to have higher interest rates, and they're not going to be able to keep them down at these ridiculously low levels for the next 2 to 3 years. So we like companies that are tied to rising inflation. We like companies that are a beneficiary of higher rates of inflation. So we will say goodnight for now. We wish you and your family the very best. We hope this message has found everyone healthy, and we will be back in a couple weeks with another update. Thank you.